The Federal Reserve needs to call a timeout and stop hiking rates. Oh, we're going to get into this one, folks. A juicy one here. Obviously, very divisive subject right now. If the Fed should stop raising rates, potentially even cut rates, if they should keep raising. We'll get into that one, react to that one. It's a buy one, get one free here today. Second video I want to react to is in regards to a stock that's been absolutely devastated. I think a firm stock is down roughly 90% or so from where the stock was in 2021. And we're going to hear the Affirm CEO speak about the state of the consumer, right? Tightening credit, tech, all those sorts of things. I think this is going to be an interesting video to react to and kind of hear what he has to say on the state of everything out there. I appreciate you guys. Much love as always. Thanks for being here. Also, thank you everybody that supports the channel on Patreon. If you want to support my content, support it on Patreon. That will be pinned comment down there. We got 800 plus patron members now. And if you didn't know, basically you can keep up to date with all the moves I'm making in the market out there in regards to Patreon portfolio. I post it up every single week and keep you guys up to date, obviously, with that. And you also get ability to enter into a drawing essentially every single month in which somebody from the Patreon actually wins a free membership to the private stock group and the private wealth group. So yeah, you get a lot of awesome things that come along with that. And by the way, I don't know if you guys have seen this on this channel or not, if I've shown this off, the new membership cards for the private stock group right here, baby. The new metal cards. And so every single new member gets one of these babies, which is pretty awesome. It's not. Is it as cool as the Seven Figure Club Award? No. Okay. Is it as cool as the Six Figure Diamond Award for when you hit 6 figures plus in your portfolio? No. But nonetheless, I like it, man. And by the way, tell me what stock that is. That's a stock chart of a specific stock out there. You tell me what it is, okay? We'll see. We'll see. Some people got it on Instagram when I posted up the other day. Let's get into this, guys.
And end the rate hikes. Peter Bookvar is the Chief Investment Officer at Bleakley Financial Group. He's also CNBC.
Thank you also, everybody. Subscribe. 24,000 and I think 800 subscribers now? Or something really, really close to that. So thank you, everybody that subscribe to the channel. Appreciate y'all.
Contributor. Peter, great to have you with us. And it's interesting how quickly people went from one side of the boat, 50, to the other side of the boat, which is either pause or 25. There is a case, though, to be made, in theory, that regulators have done so much to backstop the financial system, whether it be here in the United States or globally now, given the events over the weekend, that enables the Fed to keep, pounding out inflation and go ahead with the rate hikes.
I think that's what they're going to do. And it'll be 25. And while Powell's not going to use the word pause, he's going to basically imply a pause and that they'll take a step back and they'll see how things play out. I think from a risk management standpoint, they should be doing nothing. I mean, the world has changed. The world has changed a lot just over the past couple of weeks. And the Fed needs to really start thinking about how things unfold from here. So before the bank turmoil over the last couple of...
Wait a minute. Wait just a second, sir. Okay, before we go any further, okay? When has the Fed ever shown us it's going to try to predict the future and get the future right? It hasn't shown us that ability, to be quite frank, when it comes to Federal Reserve. It has not, right? If you look at the Fed, they're just being very reactive to how inflation's been coming in, the numbers, all those sorts of things. And so, to expect them to kind of look to the future here and make predictions about what they think is going to happen, they can't really do that. And I think the real reason they can't do that, to be quite honest, is because of how wrong they obviously were about inflation being transitory. And so I think Jerome Powell and the whole Fed in general is scared to death to make decisions based upon what they think is going to happen in the future. And that's why they're being so data dependent now at this point in time and only looking at it from the data standpoint. What do the numbers show?
We've seen the tightest lending standards, not including COVID, in commercial industrial loans since 2009. The commercial industrial loan level in terms of amount outstanding up until the day before it totally unraveled with SVB, it was no higher than December. So the economy is already in motion to the downside. The Fed should at least acknowledge that. And they also have to keep in mind that just keeping rates at an elevated level for a while is its own form of continued monetary tightening.
It's true.
Peter, it's Karen.
True.
I agree with you about what he should do, I think, is zero. But what do you think is the data, since he's data dependent, that he would need to see for, let's say, further lending tightening? Or what other metrics would you look at that they could say, all right, we're starting to see this is pressuring inflation as well, so we're headed in the right direction. We'll stay paused.
Well, unfortunately, a lot of the data he's going to look at is backward looking. We have to assume that at least small and medium-sized businesses are going to dramatically slow the extension of credit to their customers, both households and businesses, as they focus more on their balance sheet, they focus more on dealing with any bad marks that they have, they deal with potentially raising deposit rates to stem the outflow of deposits. And if you're a loan officer, you're now more interested in not making mistakes than potentially taking some risk and making new loans. So we have to assume where the economy is going to go from here, rather than them waiting for data that by the time they see it is going to be relatively old news.
Peter, can you help quantify this? I read this in the book report, your note this morning. You mentioned the C&I loans, so the commercial industrial loans, and specifically as it relates to commercial real estate. And so when you're talking about the exposure that a lot of these regional banks have to those sorts of lending, help us quantify what that means for the economy right here. Like you just mentioned some of these things. Does it really almost ensure that if standards are going to get that much tighter, that we will have a greater slowdown? So it's just amazing. We had Gerard Cassidy on before, and he's not in the hard landing camp. You know what I mean? Like, these guys are still in the soft landing, no landing camp. I just don't know how that happens.
So about 70% of commercial real estate lending comes from small and medium-sized banks. And you can only imagine what they're thinking now in terms of extending new loans that are coming due this year, or the keys that are being handed back to them by office owners that don't want to own the property. Well, you can be sure banks don't want the keys back either. They would love to see a borrower continuing to pay, because what is a bank going to do with this office building? So there's going to, and going into the last couple of weeks prior to this, banks were already sort of freezing their participation in commercial loans. And a lot of the commercial loans that were taking place were from non-bank lenders. And you can be sure the non-bank lenders at this point in the cycle are going to be charging double digits to commercial real estate borrowers in terms of interest rates.
So, Peter, we don't often get an outright, buy this or sell this from you. But would you say that there's more downside for regional banks at this point?
So I think the risk of potential dilution is certainly going to be important on the equity side. But a lot of these banks have gotten really beaten up that I do think that there's going to be some value to be had at some point. And even the biggest banks, we know that they're going to be a beneficiary of how this plays out. But I think sort of the super regionals is where investors need to look at some point. But we know it's good to buy the banks when they're trading around book value. And now over the next coming quarters, there's a good chance that book value starts to fall as banks remark a lot of their assets. But a good bank that's trading at book value or less is going to be attractive at some point over the next couple of quarters.
Peter, always great to get your take. Thanks. Peter Lefebvre.
Thanks, Melissa.
Does it matter? If the Fed, of course it matters. If the Fed does 25 and then sort of says enough, or if the Fed does nothing and then keeps a hawkish tilt, does that nuance matter?
The nuance is all that matters. I think the Fed needs to keep people on their toes, and I think they're going to try to do that. I think they still have, their most important mandate that's left is certainly inflation. I look back to where we are. We're pricing in 75, 80 bips of price cuts on Fed fund futures. By the way, last week, Rick Santelli told us not to take that as gospels. He's absolutely right. They move all over the place, but that's where positioning is right now, and that's where that nuance is important.
Is the pause, Julie, going to cause panic? Is a pause going to say, oh, my gosh, things are going awry and we don't have a good handle on it and we got to stop?
Yeah, I had a dream last night, okay? I had a dream. And I've definitely been in the markets too much, so I had this dream. And my dream was that the Fed, and I was watching it on TV as it happened, it was like, I don't know. But anyways, they cut 25 basis points and the market goes blasting off. Next thing you know, the Dow was up like 900 points. It's just like, what a dream to have, man. What a crazy little dream. Imagine that though. Could you imagine if they cut 25 basis points? Like seriously, like that would be shocking. Like no one's expecting that. Everybody's expecting 25 basis points or cut. And there might be a few people still expecting 50, but hardly anybody now.
To say, right, I that's how I would interpret it. I would interpret it as pretty negative, right? And they have access to some of the data that we don't as far as what's really under the hood at some of these banks. And the other thing that always concerns me is that recessions that are triggered by a financial crisis tend to be much deeper and harder to get out of, right? Because there's no lending that's really happening. And not, we can sit here and say, look, this isn't being triggered by, poor quality credit, but we have to think about 0% interest rates for more than a decade, and we think there's going to be no repercussions from that. We really think that all that credit quality is phenomenal. I don't know. I really worry about that longer term. And so, I think if they're at zero, to me, that signals, maybe there's more that we don't really understand that could be coming down the pipe.
100%. I think it's ludicrous to think that these major money center banks don't have similar mismatches as far as maturities. You say no.
I say no.
I will bet you, guaranteed. And let me, I'm just saying, like, guaranteed. Think about since you've been in this business, okay, when there's free money to be had, or when people think that there's free money, or there's some sort of spread, there's some sort of trade, they all do it.
There we go.
They all do it. And all of these banks are going to be forced to be really transparent. You know why? Because all these major money center bank CEOs, they're on speed dial with the White House, they're on speed dial with the Treasurer, they're on speed dial with the FTC, and there's no hiding this sort of
being
stuff.
on speed dial with whoever doesn't mean they're taking duration risk. I don't know why you equate those two things they're irrelevant to me.
Okay, well, we'll see. I mean, I'm just saying I have no knowledge of it. And
I know. Look at the 10K. You'll have some knowledge.
I think there's duration risk.
I don't think there's duration anywhere remotely close to what you're saying. If you look at SVB's books, the 10-year plus.
She basically said, boy, you don't even do research. You don't even read a 10K. Oh, nasty.
Duration risk there. Some of which is mortgage-backed securities, which we know the duration gets longer, and Tim talked about that a week or two ago. It's nowhere remotely close to what J.P. Morgan's is. And if you look at J.P. Morgan's deposits and you look what's coming in, look at their 10K.
Okay, well, let's see what the marks.
We do know from the FDIC chairman that at the end of 2022, unrealized losses were $620 billion.
Yes.
I mean, is it fair to say it's $620 billion is not just Silicon Valley Bank and Signature Bank?
Correct, but what is the denominator of that, right? And rates have moved a little bit the other way since then. And if you if you marked the mark to market, the held to maturity, the change at J.P. Morgan would actually be the smallest, pretty small on an absolute basis, and way smaller than all of the other GSIB banks.
I would agree with the denominator part, except that it's not spread across banks. It is concentrated, and we've seen what just a couple of blowouts.
But what is the denominator of assets?
Okay.
I mean, it's at least 11 trillion if you're saying it's just GSIBs.
Right, but that didn't help.
But you're also saying no hedge. You're saying no hedge.
If they hedge,
that is not correct.
If they hedge, though, okay, it's my understanding. If they hedge those books, then they have to take those marks, okay? And so my point is they might not have taken the marks just yet because they haven't had a run on their assets, Karen. So, like, that's my point. And if anything, they've taken in a lot more assets. So, like, listen.
They're taking a lot more assets right now, which are just deposits and cash.
We could have been arguing the same way in mid-March of 2008 what kind of like was going on with Bear and some of the run that was on, and we could have been saying no, all these other peers were not doing some of the same stuff, did not have the same exposure. That would have been a really bad. That would have been a really bad.
Oh, you're really going to play?
Can I be Switzerland? Because Switzerland's been in the news, and they're there to protect their banking sector. So I'm here to protect you guys. I just think that there's 2 points that are being made. I'll echo your most important point of the day, which is that credit is still out there. Credit is lurking. Karen's point is very clear. Very different balance sheets, very different approach to their lending business, and not even close in terms of the risk. They're not in the business to take that kind of risk. So welcome to the Europe. Welcome to the European Union. Nice to yes.
It's funny that you say that because a bank like J.P. Morgan has made tremendous inroads in investment banking. How do they do that? Okay, how do they do that? They do that with a whole host of other products and services, the same business model that Silicon Valley Bank was in to win a lot of those same mandates and those same customers. So what I'm saying is we just don't know, right? We don't know. And I don't know. It just doesn't seem that compelling to me. Right?
Interesting. Wow, that got a little feistier than I was expecting. I was expecting peaceful, but yeah, man. Oh boy. Okay, next one up here. Affirm CEO on the state of the consumer, tightening credit and tech workers plus more.
CEO Max Levchin today about the buy now pay later providers' risk management, especially in light of headlines like tech layoffs and consumer stress. Here's what he said.
I think the tech community, while subject of a lot of self-important headlines, is not a huge swath of the U.S. population, and a lot of those people are still just fine thanks to the pandemic amassed savings. So while they're sorting themselves out and finding new jobs, they're able to dip into savings or even use products like Affirm to sort of continue maintaining whatever lifestyle that they need to maintain. So we're not seeing significant delinquencies from Silicon Valley, for example, or Seattle area.
Hey, did you ever think about this? I think this is super important point. I don't think I've ever made this point before. I don't think I've ever heard anybody make this point, okay? Let's say you're a company. You let go, let's say you're Amazon. You let go of 27,000 employees. And almost all of those are corporate employees, right? Well, most of those corporate employees are going to own some sort of Amazon stock, right? If not a considerable amount of Amazon stock. Well, if they get fired from Amazon, there's a pretty decent probability they're going to sell a portion or all of their Amazon stock shortly after they leave, right? And especially if they're in a tighter financial spot and they need to dump shares. That puts selling pressure on those stocks, right? So I just think that's kind of something that maybe isn't even talked about or seen out there that I think is very important.
We'll continue, but we'll obviously monitor this very, very carefully. On the other hand, folks that are kind of middle America, and that is the vast majority of our consumer, people that are 90 to 100 miles inland from coasts, that consumer, depending on where they are financially, is starting to feel some stress. There's disruptions on the margins for some folks that are, especially hourly employees that are employed sort of with the expectation of relatively temporary employment. There's some disruption towards in that world. Not a lot. Not a lot. The number one factor.
Okay, so he said not a lot, but that sounded scary at first, the way he was putting that.
Or consumer stress that we're seeing is really things have cost more than I expected them to. Things like gas, things like food, especially if you're feeding a large family, those expenses start ballooning.
Inflation. That said, Affirm isn't giving credit as freely as it did a couple years ago.
We've been working to manage our credit result very, very actively. This sort of weekly routine during the height of the pandemic when credit was exceptional because the government was paying everybody's bills. I would review credit results once every 2 weeks. And I felt very comfortable doing that after a glass of wine with dinner. These days, my Sunday nights are dry because I am going to go through the credit numbers very carefully, and then I have to be prepared to ask intelligent questions Monday morning. And so my attention to it has increased dramatically, but what we have been able to do is find ways to say yes to consumers while protecting ourselves to the downside. So, for example, our requests for down payments have gone up a lot. And so that's one of the ways of figuring out, is this consumer actually planning to repay? Is there an expectation? How good do they feel about their ability to pay us back 6 weeks from now, 6 months from now, et cetera?
And what happens when you do that? Do a certain number of the requesters just say, never mind?
Absolutely.
So, tightening access to credit, but one way of doing it, getting consumers to self-select out by asking them to pay a down payment.
Yeah, it reminds me of the conversation we had with...
I'll tell you a story, okay? You know what? Let me let them finish, and then I'm going to tell you a story about when I worked at Quick Trip and something we tried. And boy, did that thing go bad. Oh, you got a story ahead of you.
Of Klarna a couple weeks ago on the show, too, and sort of the differences between these buy now, pay later companies in terms of how they are thinking about. They all seem to be very focused on credit and the credit worthiness of their customers, but how they're approaching it with things like, I remember Klarna's CEO talking about incentivizing people to make their payments with fees if they were late, for example, which I know is very different than what Levchin does at Affirm.
It is different. Interesting. He argued that in this environment, lenders actually want Affirm-type debt on their books because it's short term. A firm has staked its reputation on vetting these consumers. So he thinks they're actually going to do pretty well during this period, but no wine with dinner. He's being very careful, he says, about the kinds of consumers he's offering credit to, saying no more often.
Yeah, and it speaks to what we've been hearing in general coming out of this earnings period, the fact that you do have more consumers tightening their belts. You have lower end consumers, for example, continuing to spend money on groceries where things cost more, but maybe not spending as much on discretionary. You have higher end consumers that are trading lower into private label as well, something Walmart has talked about repeatedly too. And it sounds like you're hearing that on this end of things too. It's going to be something to watch with all the earnings, consumer-focused earnings we get this week.
The lenders, in some case, tightening the consumer's belt for her or him.
These guys do pretty good, but I don't know why they got rid of Scott Wachner on the whole closing bell overtime, man. He had that great segment and he'd bring somebody on the desk, they would talk. I don't know why they're switching it up, but okay, story time, okay? And I think this is probably happening with a firm, okay? And all those companies that kind of compete with a firm, in my personal opinion, okay? So when I moved out to the Charlotte division to help Quick Trip expand out there, right? This was like 2013 or whatever, right? You know, obviously we were trying to build business and, get people to know about us, right? QT. And so we had a program called basically a pump start card, okay? And all you had to do was just, put in your driver's license and you got this pump start card, right? And with this pump start card, you got to go out literally and it just opened the pump and you could pump as much as you want. And then you're supposed to come in and pay afterward, okay? Well, after a little while, word started to spread around Charlotte of these pump start cards. And what started to happen is many people would come in, get the pump start card, pump all their gas, fill their tank up full, $60, $80, whatever it took, $90, right? And just leave. And they had no intention of they had no intention of paying back that money. They had no intention of coming in and paying. They just came in to get that pump start card, pump a free tank of gas in their opinion, right? And then take off. And they knew we weren't going to hunt them down for that $60 or that $80 or $90 or whatever, right? And so I believe that with a firm and some of these companies, I believe they're probably being, let's call it, scammed. And I believe some consumers have been taking out money and buying stuff, and they have no intention of paying it back because it's seen as not nearly as serious as, let's say, a credit card or, a bank loan or something like that. They're like, who cares? It's just a firm company or whatever. I'm going to go buy this flat screen or whatever, right? And then maybe you could even buy it and then sell it to somebody else. So that's my opinion is what's been happening with them. And I wouldn't be surprised if their kind of delinquencies and people that don't pay goes up quite a bit over this next 6 to 12 months. We'll see what plays out. But that's my opinion. There's always going to be some of that in the market. So, and once word spreads, it spreads quickly in regards to that whole situation. So anyways, guys, appreciate you joining me as always. Thank you so much, everybody that supports the channel on Patreon. I appreciate you all. It's $10 to join us in there, support the channel, and also get access to see what moves I'm making out there in the market, as well as get ability to enter into our monthly contest each month, where you could potentially win a membership to our private stock group and the private wealth group. Appreciate y'all. Much love. Thanks for being subscribed, and have a great day.